You're about to see something that only institutional investors have been whispering behind closed doors. Over 800 billion in multifamily debt is coming due between now and the end of 2026, and most owners, they're not ready. 2008 was a financial bloodbath, but while the headlines focus on Wall Street, a few sharp investors made billions, quietly buying distressed multifamily properties. Today we're staring at something bigger. The debt wave is larger, the leverage is higher, and the pressure, it's already cracking the surface. The question isn't whether a correction is coming, it's who will control the rest. It's who will control the reset. So let's set the stage. It's early 2024. The headlines are full of cautious optimism. Vacancy rates are stable. Rent growth has slowed but remains positive in most markets. Institutional newsletters whisper about opportunities on the horizon, but the mainstream narrative is that the worst is over. But behind the scenes, the real story is playing out in spreadsheets and loan maturity schedules. Over 800 billion in multifamily debt comes due at the end of 2026. This isn't just a statistic, it's a ticking clock. And most of this debt was originated during the era of cheap money, with floating rates and aggressive underwriting. Now, as rates have doubled and sometimes tripled, the math no longer works. Many owners, especially those who bought with bridge loans or short-term repositioning capital, are realizing that their business plans have been compressed. What was once a comfortable 3 to 5 year window to execute value-add strategies has shrunk to 12 to 18 months. Lenders facing their own pressures or tightening standards, higher debt coverage ratios, lower loan-to-value ratios, and demands for fresh equity. The result? A wave of forced decisions. Some owners will sell early to avoid distress, others will attempt to refinance and only find the terms unworkable, and a growing number will face the prospect of handing the keys back to the lender. While smaller owners scramble, the most well-capitalized players are preparing for a generational opportunity. At industry conferences like NMHC, the mood isn't panic, it's anticipation. See, major funds are stockpiling dry powder, strengthening relationships with top operators, and quietly buying non-performing notes before properties even hit the foreclosure stage. You see, their strategy is clear. Control the asset before the headlines hit. They're targeting Sunbelt markets with strong demographic tailwinds, places like Dallas, Atlanta, Phoenix, and Tampa, where population growth and job creation remain robust. Value-add properties with 20 to 40% upside potential, especially those where owners are unable to complete renovations or lease the plans due to capital constraints. Owners showing distress signals, equity partners backing out, leasing velocity stalling, capex halted mid-project. Most telling these institutions are building entire acquisition teams, not for today's deals, but for the deals 6 months from now, when the headlines start to shift and the real opportunities emerge. So let's dive into the numbers. Bridge loan volume in 2021 to 2022 was 300% higher than the prior 5-year average. 72% of those loans had floating rates, exposing owners to significant interest rate risk. Cap rates compressed to historic lows, often below 4%, making it difficult for properties to cash flow when debt costs rise. Insurance premiums have risen 30 to 70% in some regions, especially in states like Florida and Texas, further eroding net operating income. NOI growth has slowed or reversed in 58% of primary metros as rent growth stalls and expenses rise. And when you add all this together, you get one thing: forced selling. The market won't collapse in a dramatic fashion. Instead, it will consolidate. The question is, who will do the consolidating? Institutions have more money than they have insight. They're underwriting not just for internal rate of return, but for control. So here's how. Locking in assumable debt at discounts, taking over favorable loan terms from distressed sellers, securing favorable terms from regional lenders desperate for yield, often negotiating lower rates or more flexible structures, modeling 3-year hold periods with 18-month cash-on-cash spikes, allowing for rapid value creation and exit. Meanwhile, small to mid-sized operators are distracted. They're fighting local evictions, navigating a patchwork of regulations, and struggling to cover insurance spikes. This creates what Warren Buffett calls a behavior gap. Institutions have a plan, everyone else is reacting. The result? A widening gulf between those who can act strategically and those who are forced to act out of necessity. You have two options. 1, sell before the headlines hit. 2, restructure before you're forced to. This isn't doom and gloom, this is a realignment. But if you wait until it's in the papers, the opportunity's gone. That's why we prepare now, not later. So let's break down what's really happening beneath the surface. The so-called debt maturity wall is not just a metaphor, it's a reality. When 800 billion in loans mature in compressed window, the entire ecosystem feels a strain. Lenders become more selective, equity partners get skittish, and transaction volumes spike as owners rush to avoid distress. Negative leverage occurs when the cost of debt exceeds the yield on the property. For many owners, this is the new normal. properties that once threw off healthy cash flow are now bleeding, forcing tough decisions about capital infusions, asset sales, or even foreclosure. Complicating matters further are new regulations. Rent control discussions are heating up in several states, while insurance costs, already up 30 to 70% in some regions, are pushing operating expenses higher. Local governments eager to avoid a wave of evictions or tightening rules around tenant protections, making it harder for owners to manage through stress. Institutions are playing chess while everyone else is playing checkers. So here's your playbook. Preemptive acquisitions. They're not waiting for properties to go to auction. They're buying non-performing notes, negotiating directly with lenders, and stepping in before the headlines hit. Strategic partnerships. By aligning with top operators, they ensure that assets are managed efficiently, even in turbulent times. Data-driven targeting. Advanced analytics allow institutions to pinpoint markets and assets with the highest risk-adjusted returns. Flexible capital. With billions in dry powder, they can move quickly, often closing deals in days rather than weeks. For small and mid-sized owners, the landscape is far more challenging. Many are facing a perfect storm. Rising debt costs that wipe out cash flow, equity partners unwilling to put more in capital, lenders demanding fresh equity or threatening foreclosure, regulatory hurdles that make it harder to reposition or sell assets. The result is a wave of forced sales, often at discounts, as owners scramble to avoid deeper losses. So what does all this mean for the multifamily market in 2025 and beyond? In one word, consolidation. The next 18 to 24 months will see a massive transfer of ownership from smaller, undercapitalized owners to larger, well-funded institutions. This isn't just a cyclical correction, it's a structural shift. The winners will be those who can act decisively, leverage data, and deploy capital at scale. And for those prepared, the coming reset represents a once-in-a-generation opportunity. Institutions are positioning themselves to acquire assets at discounts, lock in favorable debt, and ride the wave of growth. But for owners who are unprepared, the risks are real, and the window to act is closing fast. If you're an owner, the message is very clear. Don't wait. Assess your portfolio, understand your debt maturities, and develop a plan. Whether that means selling, refinancing, or bringing new partners, the time to act is now. If you're an investor, focus on fundamentals. Look for markets with strong job growth, population inflows, and manageable regulatory environments. Partner with operators who have a track record of navigating turbulence. If you're a broker or advisor, your clients need clarity and honesty. Help them see the future, not just the rosy scenarios. You see, the game is won before it's played. The institutions know this. They're preparing, positioning, and executing with discipline. The rest of the market is just starting to wake up. And in the next video, I'm breaking down the 3 specific lending programs institutions are using to reposition distressed assets. We'll cover where they're getting debt, how they're underwriting cash flow in a rising rate environment, what terms you should be asking if you're a buyer right now. So don't wait for opportunity to knock, open the door. So subscribe, hit the bell, and I'll see you in the next one.